Traded. Moving on, it's earnings season once again, and the market prepares to take its cues from the sectors and stocks that are set to surprise the street estimates. In fact, we caught up with Dipen S, head of institutional equities at HDFC Securities, on the recently buzzing counters, that's Infosys, and which is the better bet between Infosys as well as TCS. Let's listen in.
IT has been actually one of the places to hide in equity markets over the last couple of years, despite all the headline worries around digital disruption in their business, the impact of AI and automation and all of that, the shift to the cloud. I don't think Indian IT majors, not to mention even the mid-caps, have done anything that can be classified as less than inspiring over the last couple of years in their respective business segments, barring one or two exceptions. I don't see that changing, despite the mildly softer outlook expressed by the Gartners and Forresters and ISGs of the world. I don't see that changing anytime soon, because most Indian IT services companies are still gaining revenue market share. Some of them are letting go of pricing a little too aggressively. Infosys comes to mind. They are letting go of margins. The margin sacrifice at Infosys doesn't excite us. Their headline growth numbers are a tad ahead of TCS for a change, and that is what is getting investors excited. But like I said, the margin sacrifice at Infosys has got me worried. Net, we think there are better bargains to chase. We are happy giving Infosys only an 18x multiple, whereas we look at TCS, we assign it a 24x multiple for obvious reasons. Here's a company which is 1.5 times the size of Infosys or thereabouts, and it isn't having to sacrifice margins like Infosys is having to do to maintain its close to double-digit growth trajectory. Both companies should do roughly similar comparable growth this year, give or take 100 bips. This way or that way. But if the margin gap is, instead of narrowing, widening, both are downwards on margins, of course, but TCS is letting go of very little on margins, and to my mind that indicates a much higher quality business. Yes, the headline news flow in Infosys is more inspiring right now, but like I said, 20-21% attrition, letting go of margins, making brave noises on profit distribution at a time when even buybacks have become less value accretive than what they were even a month ago, doesn't add up to much which can excite me. The stock has run up post the results. I think the smart investors should sell into the rally and accumulate TCS.
Should we be again sort of reasonable enough to expect a similar performance from HDFC Bank or Kotak Bank, Axis Bank? Is it a sector-wide phenomena, or there could be some niche performances?
So the broader picture around the financial sector, and which is now, I guess, a little over a third of the lead index, the broader picture there is a confusing and mixed one. The lead index. The broader picture there is a confusing and mixed one. The old story of private sector growth and metrics being demonstrably superior to the public sector continues, no doubt about that. But then there are, big parts in the credit system which are gasping for breath. The blow-ups at a couple of NBFCs, one of them pretty large, a large housing finance company, for example, are just too big now to be ignored. The meltdown, if I can call it that, at DHFL, and even within the banking space, the trauma that Yes Bank is going through, the question of not just the asset books being under stress, but even broader systemic problems emerging from these headline cases, not to mention the long string of NBFCs which is going through trouble. I think that indicates that all is not well with the sector. However, there are some very smart people within the sector who have been able to ring fence and safeguard their own books from this stress. For a long time we thought Yes Bank was one of them, but we were all proved wrong. But I don't think the ones which are left now, which are outside of the stress curve, are likely to be significantly affected. Yes, you might see slowdown in growth, you might see a little more stress crystallizing in some of their corporate books, for example. But I don't think there is going to be a breakdown of thesis, of investment thesis at fast healing names like, let's say, ICICI Bank or Axis Bank anytime soon. The relatively safer books, so to say, so whether it's our own parent bank, HDFC Bank or Kotak, I don't think anything much is moving in many of these cases as well. I'm happy you mentioned IndusInd Bank, because this is a bank which has gone through a little bit of a disillusionment with investors over the last quarter or so, especially after I think a not so well handled disclosure and tackling of the problems around their exposure to the IL&FS group. But that is behind now, and that is in the numbers, the recognition, the write-off and all that they had to do. Much of that has been done. I think it's a very, very capable management. They've got fat fee income streams, they've got a very diversified book, they've got a fast-growing automotive finance book which has stood them in good stead in terms of high yields and good growth. They've had a very tightly managed corporate lending book, which is also with their capabilities in sell down and so on, they've been able to get fat fee income streams going as well. They've got a very strong emerging deposit franchise which bodes well for them.